Hello and welcome to S&P Global Ratings Fixed Income in 15, a 15-minute chat with a market voice and an S&P ratings analyst. My name is Joe Cass. I head up market outreach in the UK. Today I'm joined by two sterling guests, Kristina Hooper, Chief Global Market Strategist at Invesco, and our Chief Economist for Asia Pacific, Shaun Roache. Thanks very much for your time today, Kristina and Shaun. Before we start, a quick reminder that the views of the external guest on the show today are their views alone, and they do not represent the views of S&P Global Ratings. Okay, Kristina, let's start with some questions for you. A nice broad one to kick things off. What is your outlook for the markets?
Well, my outlook for the markets is very different from my outlook for the economy. Certainly in the US and to a lesser extent globally, I expect the economic recovery to, at least in its initial stages, be slow, halting, and uneven. Certainly, that would be more pronounced in the US because the difficulty controlling the virus. But having said all that, what we've seen is a decoupling of markets from the overall economy, just because of the massive stimulus, particularly monetary stimulus that we've seen. And so my expectation is that risk assets continue to perform well for a variety of reasons, not just the Fed put or the central bank put under stocks. And other risk assets, given the creation of specific Fed facilities for areas of the fixed income market, but also because in a world of yield scarcity, one needs to move out. Many are forced to move out on the risk spectrum. So for a variety of reasons, I expect risk assets to perform well, but that doesn't mean that there isn't fear in markets. And so I would expect that to be manifested in not only continued popularity of areas like treasuries, but also other perceived safe haven assets such as gold.
Great. And do you foresee, Kristina, any major trends in the global fixed income side of things today and going forward?
Sure. Well, one not surprising trend that we're seeing is that rotation by many clients out on that risk spectrum when it comes to fixed income, including a rotation to a certain extent out of investment grade into high yield. I understand that yield scarcity is a very real problem, and it's certainly something we encountered during in the wake of the global financial crisis and after. But what I would say is that hopefully investors remain very well diversified, that even if they move into what is perceived to be more alternative fixed income, they continue to have broad exposure there. One other thing I would say is what we're also hearing from clients, and I think this is being fueled by interest and excitement about the potential for a great reset, is a focus on ESG in fixed income. In fact, what we've heard from some clients is it's more important to have ESG exposure in one's fixed income portfolio than in one's equity portfolio, which to me is a very new concept, but it's very exciting. And again, I think it's fueled, at least in part, by enthusiasm over the potential for a great reset coming out of this massive crisis.
Fantastic. Insightful comments, especially around the ESG side of things. So, Shaun, over to you now. So, 2020 has been a year of volatility in global markets with APAC and China taking center stage, really, due to the coronavirus and its impact. As someone who's been on the ground over there during this period, how are APAC and China faring economically versus the rest of the world?
Asia and China are actually coping quite well, all things considered. If you look at economies like Korea and Taiwan, the economic impact has been quite moderate. So, you might wonder, why is that? Why is Asia proven to be quite a strong performer, all things considered? And I think there are three reasons. The first one is that here in Asia, we have had experience of pandemics before. We lived through SARS in 2003, and that encouraged governments to act early, but it also encouraged citizens to start social distancing very quickly and wear masks, and that had an impact. The second reason is that policymakers here in the region were very quick to come out with targeted policy support for industries and employers that were under pressure. That's also proven to be very effective. And thirdly, I think this is a little bit of good luck for Asia. Asia's making the right stuff. So everybody who's at home and wants to get a new headset, they want to get a new webcam or a new laptop, the chances are that a lot of the stuff that you're buying comes from Asia. So Asia has really benefited from the electronic cycle. But at the same time, I don't think it's time to crack open the champagne. It's going to be a long, hard road ahead, as Kristina suggested. And we can look around the region and see that it's not all good news, given what we're living through. First of all, China is recovering, but it's a very unbalanced recovery. And there's still some work to do to make sure that it's self-sustaining. Consumers in particular are still not really spending in China. The second issue is that by Asian standards, jobs are being decimated. A lot of people are losing their jobs, and it's going to be a long time before we go back to pre-COVID levels of employment. And finally, not all countries in the region are doing well with COVID itself. So we know in some cases, India and the Philippines are two good examples where they're finding it difficult to contain the virus. They don't provide as much policy support as other economies, and that's showing up in their growth numbers. So we could see substantial declines in GDP for some economies in our region, and India and the Philippines are the two economies that spring to mind.
Focusing a bit on China, so their relationship with the US seems to be evolving constantly. So from your perspective, why does the nature of the relationship matter for economic growth, both now and in the future?
Yeah, my go-to phrase for US-China from an economics perspective is that perhaps people are overestimating the short-run impact and underestimating the long-run impact. And the reason why is that this relationship in economic terms is mostly about technology. And in the short run, over say 12 to 18 months, it's really hard to move a big, complicated technology supply chain from one country to another. In fact, our analysts in the US and Asia came together and wrote a great article about this just in the last week or so, pointing out just how difficult it will be for these supply chains to move. So don't expect anything to happen too quickly. But at the same time, in the long run, what we do know is that technology drives productivity, productivity drives growth, and anything that slows down the transfer of technology, the investment in technology, will show up in productivity and growth in the long run. And frankly, at the moment, China needs more productivity growth if it is to continue growing at between 5 and 6% over the next decade. So anything that threatens that could see China's growth slow a little bit more than people think.
Great. Well, so now we're going to move on to some non-market related questions. Kristina, I'll start with you. You've been at Invesco for coming up to 4 years now. How has the whole working from home transition been for you so far?
Well, as someone who, in a past life, pre-pandemic, was a road warrior, who either was commuting a long distance to work or on a plane somewhere around the world, this actually has been a welcome respite. It's actually offered the opportunity for me and actually my entire team to be able to connect with more clients. I think we're all working a lot more efficiently. And I have to say, there have been some really positive personal benefits as well. As the mother of 3 kids, including one who is about to leave for college, that ability to spend some months together was really a gift in the midst of an enormous amount of sadness and heartbreak and devastation. So for that, I'm really grateful.
Shaun, in times past, I understand that you were a keen rugby player. So after 23 years out of the game, you started playing again in Singapore. That's very impressive and quite brave, really. So how was your return to action? And are we going to be seeing you appearing in any Masters rugby tournaments in the future?
No, you're right, Joe. So I did have an itch to scratch, and after 23 years, I did scratch it. So I went back to contact rugby, and I played in a tournament in Cambodia. And I started off very gingerly, but as the tournament progressed, I gained in confidence. And about 4 games in, I was galloping down the wing, wind flying through my hair. I'd returned to being 25 once again. And about 2 seconds after that, I was almost decapitated by someone about 25 kilos heavier than me. At that point, I decided that perhaps I needed to reconsider. Whether I will return to the field, I think I'm going to leave that question up to my wife and daughters.
Sure, sure. So Shaun, you've lived in Asia for 7 years now, during which time you've learned or are learning the Chinese language. So my guess is it's a very difficult language to master. Personally, I can just about get by with English. So how has your learning experience been?
You know, if one needs proof that your brain fossilizes with middle age, learning Chinese delivers that proof very quickly. As you say, Joe, I've been learning for about 7 or 8 years. I can get around taxis and hotels. Unfortunately, when I start talking in conversational style, the only people who can understand me are other foreigners learning Chinese, which isn't really the point. So again, I think just like rugby, I'm going to have to reconsider.
So the final question goes to you, Kristina. You've been in the markets for over 15 years at some major firms, major investors, PIMCO, Allianz, and now obviously Invesco. So which individual from the financial universe would you recommend that I invite onto Fixed Income in 15 as an upcoming guest?
Without a doubt, I believe it is Richard Clarida. Richard is one of the smartest, but most humble economists you could meet. And I believe that he not only has been incredibly insightful, but when history is written about the Fed in this era, it will show that Richard had a very, very big influence on the pivot made by the Fed under Jay Powell's leadership. You may recall when Jay Powell joined as Fed chair, I mean, he was already part of the Fed, but when he became Fed chair in early 2018, markets swooned. There was a lot of concern about Chair Powell because of some of his comments and concerns that he was willing to become less accommodative quite quickly. And it really wasn't until I think Richard Clarida joined that we started to see some changes. And by early 2019, we had seen a pretty significant Fed pivot. And today, of course, we see Chair Powell as someone who is very, very concerned about Main Street America. And I think some of that has to do with the influence of Richard Clarida. I don't know that for a fact, but I certainly think he would be a wonderful guest. He always has great insights and has a wonderfully interesting, long, storied career.
Yeah, and that sounds like a good recommendation. I was actually at PIMCO in 2011 for 4 years in the London office when Richard was in Newport Beach, and I remember him being held under very high esteem. And so maybe I will reach out to Richard and see if he's free.
And he was held in high esteem with good reason.
Well, great. Thank you so much, Kristina. Thank you, Shaun, for your time today. Thanks for watching, and see you next time on Fixed Income in 15.